Concerning new data suggests that the U.S. economy is about to enter stage 4 of the recession in 2023, and it's going to be this stage where you can expect to see a skyrocketing unemployment rate as well as plunging home prices and stock prices. And to talk about the U.S. economy's progression into stage 4 of this crash, I have a special guest on the Reventure Consulting YouTube channel today. That guest is Adam Taggart, a financial and economic expert. And so Adam, tell my viewers, what do you have to say about what you're seeing in the economy right now?
I'll start with a chart of the Conference Board leading economic indicators. This chart takes the 10 most effective leading indicators and it aggregates them into an index. Year over year, this index has dropped negative. Now I think it's down about -7%. But over the last 40 years, every time that this indicator dropped below zero and went negative like it is right now, stayed there for 2 or more months, we're in a recession 100% of the time.
So that data point aggregates different economic indicators, and it's saying that we're already in a recession, basically. However, certain aspects of the economy don't look like we're in a recession. The unemployment rate's still record low, 3.5%, and more people are thinking like this recession isn't going to happen. What do you have to say to that?
I have a lot to say, and much of it is based upon a recent interview that I just did with Piper Sandler's chief strategist, Michael Kantrowitz. Michael has a fascinating framework for basically measuring how an economy progresses into recession. He calls it the hope framework. So it starts always with housing. Housing moves first. When basically central banks change their policy, housing is one of the fastest asset classes to react because it's so highly leveraged that changes in the interest rate affect home prices. Then with a lag, oftentimes measured in months or maybe even quarters, we begin to see an impact on new orders. So orders, that's the O in hope.
Is that manufacturing orders?
He looks at a number of different inputs for each one of these, but yes, basically he's looking at new orders. Oftentimes, the ISM manufacturing report is a key indicator that goes in there. And you think about it, okay, so if people are beginning to feel less confident about their economic future, obviously orders are going to go down. If they're feeling more confident, orders are going to go up. That makes sense. That then influences the next stage of the progression, which is corporate profits, P for profits. And hey, if orders are going up or going down over time, that's going to translate into higher or lower earnings. And then the last stage of this progression, the E, is employment. So if companies are making less money, their earnings are going down, eventually they're going to have to start cutting staff, right? And that's going to start reducing employment. This progression, again, is time honored through all the economic cycles that we've had here in the country.
So on the Hope Index, it sounds like we've had 3 of the 4 occur so far, if I'm reading this correctly. We've had a big collapse in home sales in America. We're at a close to 25-year low in home sales. So housing has collapsed. ISM manufacturing orders have collapsed. Now we're seeing corporate profits in this earnings season. Lots of companies are down 20 to 40% year over year on earnings. So have we seen 3 out of those 4? And is the next one that we're going to see the employment and all the layoffs and the increase in the unemployment rate?
The answer is yes, right? So to your point about people saying like, hey, why worry? Employment situation looks strong, right? The job situation's robust. We've been hearing that forever. People have been looking at that as a bulwark against recession and making the assumption that because we haven't seen that domino fall yet, that we don't have to worry about a recession. What Kantrowitz's progression says is, hey, we can have a lot of confidence that that final employment domino is going to fall because that is the progression. You're absolutely right. So you'll see here that in housing, the survey of home builders, home building confidence, that peaked back in November of 2020. As I talked about, this overall progression, when you add everything together, usually happens over the course of a couple of years. We're seeing that here. Orders then peaked in March of 2021. We're seeing profits begin to roll over here. As you said, it looks like their peak was in June of 2022. Now the question is, well, look, are we likely to see a peak in employment here? And if you look at the data, it does look like we are finally coming off the nadir of the unemployment rate and things are beginning to pick up here. If the progression holds true this time, and I think we can have a fair amount of confidence it will, both for history's sake and for some data I'm going to bring up in just a moment, we should expect to see that unemployment rate begin to creep up from here. And if we do, that is the final kind of game on signal that Kantrowitz is looking for here, is when that final 4th domino of employment begins to really fall over. That's when the new bear market really gets going. And that sets the timeline on recession, where you can expect recession to really begin to hit visibly within a matter of months.
I mean, that's some crazy data, Adam. I really appreciate that because it suggests that we could be on the doorstep of something big right here. And I know a lot of people have fatigue, let's say, with the recession. It's been talked about for a year, but you look at some of the leading indicators on employment, continued unemployment claims are up about 40% from their low that they experienced in September 2022 to where they are today. To your point, they're still historically not that high, but employment can change fast. And I think when it does, when the unemployment rate starts shooting up, you tell me if you agree, I think you're going to see the mentality of a lot of people in the housing market and stock market change. When I look at the housing market and stock market right now, I see a downturn in both of them. I see a lot of people acting like the recovery's here and things are going to get better from here on out. What do you think is going to happen? Say the unemployment rate goes from 3.5 to 7% over the next 12 months. How do you see that impacting both the housing market and the stock market?
My outlook and position is basically influenced by the experts that I interview every week, 5 to 6 times a week, day in, day out on Wealthion. That's what I do for a day job. And at this point, the vast majority of the experts that I talk to do not see how we avoid a recession here in 2023. And at some point, the markets, to your point, Nick, they're going to have to realize that they've just been way too sanguine right now. I think markets, especially recently, have been, I think, almost deliberately ignoring the data and really just trying to hear what they want to hear whenever the Fed speaks or whenever a new data set is released. I think that they are, to a certain extent, living in fantasy at the moment. Now, that's one man's opinion. But regardless, I think that whether it's, the market's expectation for a Fed pivot sooner rather than later this year, which I don't think is going to happen, and you and I can talk more about that in just a second, or their confidence that employment is going to remain high, unemployment's going to remain low, or their belief that Q1 and Q2 were the worst parts of the earnings cycle, and then things are going to start growing again from then on. At some point, the delta that exists right now between the macro data and market expectations is going to have to be realigned.
By realign, just to be clear, you mean the prices are going to have to come down closer to the fundamentals, because you look at both the housing and the stock market, they're historically overvalued, right?
Yeah, and I just don't see a catalyst for to support these current prices. There has to be some sort of catalyst for growth. And I just don't see that right now, because I see interest rates remaining high, probably going a little bit higher from here. But even if they don't, even if Powell just pauses at the next Fed meeting, but holds good on his promise to then hold them steady for the rest of the year, that is a ridiculously high cost of capital that this economy is not used to. This economy has adapted to close to ZERP type of capital costs, and we've jacked up the cost of capital tremendously quickly, tremendously fast. I think the economy is still in the process largely of going into shock from how fast that happened. And then, of course, on top of that, we had the instability in the banking system. What that has done has forced banks were already tightening their lending standards, but that has accelerated the tightening of their standards. And as Jerome Powell himself said the other week, that's substitutes as additional Fed rate hikes. So that's increased tightening that's going on above and beyond what the Fed itself is doing here. I just don't think the economy can remain healthy under those standards, given what it's used to. And real quick, you and I have talked in the past about how important employment is to housing, right? Because essentially at the end of the day, home prices have to be a function of what local salaries can support. Going back to this Kantrowitz's hope progression here, right? If that domino falls over, that is nothing but bad for housing here. Let me just give you a couple numbers here about the jobs market as it stands right now. First, we are starting to see this, incredibly robust jobs data that we've been getting reported by the government over the previous couple of quarters. It's beginning to moderate. So the ADP March payrolls, they came in at 145,000. That's down from 261,000 in February. That's a very big month over month decline. The job openings report, we've been hearing about how there's way more job openings than there are applicants to fill them. That is still the case, but the latest JOLTS report showed that job openings fell to a 21-month low in February. So again, bloom is beginning to come off the rose, even on the official government data that's being reported. Real quickly, tech layoffs continue gaining steam. Layoffs in the tech industry are way worse than they were during the COVID era, where we shut down the global economy. And more tech jobs have been lost so far in 2023, and we're just into April so far, than were lost in all of 2022. So that tsunami of job losses in tech is continuing to accelerate. But the big story about layoffs is it's not just tech anymore. We're seeing contagion of layoffs in almost every sector that you can think about there. And just very quickly, here are just some names of the largest companies that are laying off employees in 2023. Dow Chemical, General Motors, 3M, McKinsey, Disney, Walmart, Accenture, Citigroup, Opendoor, FedEx, BlackRock, Goldman Sachs, and many, many others I don't have time to mention here. But you'll notice none of those brands I mentioned is a tech brand. Those are all big established companies in a whole variety of different sectors here. So this contagion is really real. So, if you're thinking that bulwark against recession, that last D of employment in Kantrowitz's framework is not going to topple, I got to tell you, the data on the ground is showing that the ground underneath that domino is getting really, really shaky.
Yeah, that's some great data, Adam. I mean, the layoffs are spreading, right? This is not just isolated anymore to some bougie tech workers in California. This is happening all across the country in different industries, and it's likely to get worse for the reasons you just said. And another layoff announcement I want to add on to that I thought was interesting was Best Buy. Best Buy is now laying off hundreds of workers over the next couple of months, and they've laid off about, I think it's around 10 to 15,000 from their pre-pandemic levels. And that's an interesting one to me, but that's a retail store, and they're laying off people too. Additionally, in terms of earnings, right? Almost every company that's announcing earnings right now is seeing a big decline, 20, 30, 40% year over year. In particular, an interesting earnings report for me was Albertsons. They're one of the biggest grocery chains in America. Their earnings were down 30% year over year. So this is something that's spreading. And I now want to get into an important point of discussion that you mentioned before, which is the Fed. What is the Fed going to do? Because on one hand, the economic downturn and collapse is coming, right? We can kind of see it. We can see it coming. We can see the train about to hit us. But on the other hand, inflation's still 5% year over year. We're seeing, used car prices go back up. We saw home prices go up in March. So what is the Fed going to do over the next 3 months and over the next 12 months, in your opinion? Are they going to keep hiking, or are they going to do an emergency rate cut?
I do not think they're going to do an emergency rate cut. I feel pretty confident taking that bet. The reason why the Fed is singing such a different song this year than it has in years previous is inflation, right? That's been the game changer, right? But that is the Fed's stated top priority right now. And it's got this dual mandate, right, of price stability and full employment. Powell has long said over the past year, I'm going to sacrifice jobs to get inflation under control here. So just to be clear, everybody, this is my priority number 1, 2, and 3. Inflation is beginning to come down, right? So the Fed is beginning to, make progress in its battle against inflation, but it still remains, far too high. It's nowhere near the Fed's stated target of 2%. The economy is still suffering from the price impacts of high inflation, both for input costs and things have gotten so bad that now retail spending is beginning to decrease, right? We're seeing a decrease in retail sales because the consumer is struggling under all this. So Powell has been, to his credit, he has been extremely consistent and said, look, I am not letting up until we get inflation back to 2%. I think if we do see a pivot this year, it's not going to be a surprise. There's going to be something so badly on fire that it's going to have all of our attentions, and the world is generally going to be begging the Fed to pivot.
Adam, doesn't this all really come down to one simple thing in the end? Whether we're talking about the Fed pivoting or the housing market or the unemployment rate, it all comes down to the U.S. consumer, really, right? I mean, consumer spending is 70% of U.S. GDP. You mentioned that data point earlier about the retail spending in March went down 1%, more than expectations. We're seeing all types of headwinds now for the U.S. consumer with a low personal savings rate and other things. Is the U.S. consumer able to keep spending throughout the rest of 2023? I mean, what do you think? Do you think the consumer spending is going to keep going down? Or is the consumer going to find a way, maybe with more credit card debt or through some other avenue to keep it up?
I'll try to be direct and just say no. I don't think they're going to be able to. They're going to try. And part of this, Nick, the unknowable part of this for me is, what's been sort of driving consumer spending up until now has been the pig in the python, or the pig through the python effect, right? Where we just pushed a tremendous amount of stimulus into the system following the pandemic. I mean, truly unprecedented amounts that pushed a lot of additional money out into the world, and it made its way to real people, and they paid down debt with it. They put it into savings. They also bought a lot of stuff they didn't need to buy as well. We're beginning to see, as that money's beginning to run out, all of a sudden consumer debt levels are back off to the races. In fact, we're back to record levels of consumer revolving debt. But what we're seeing right now is that we are in danger of hitting what's called debt exhaustion or debt saturation, right? Which is where, even if they want to, consumer households can't take on any more debt. Either they're so indebted at this point that if they were to take on more debt, then they wouldn't be able to service the debts that they have. Or even if they're not thinking that way and they still just want to get whatever more debt they can get, the lenders are saying, sorry, buddy, we're cutting you off.
Okay, so we have the struggling consumer, we have the Fed increasing interest rates. We have all the leading indicators saying we're in a recession. And now on top of that, we have a credit crunch, or what looks like a credit crunch at the beginning stages where banks are tightening lending, bank credit is decelerating. I mean, how is that going to play into this, right? That's another big headwind. Can you explain to the viewers like how banks reducing credit availability, how does that work its way through the economy and eventually, cause job losses and asset prices to go down?
Sure. Just think of it this way, that credit is essentially the lifeblood of the economy, right? It literally is what circulates that makes the economy work, right? And that's why to goose the economy, when the Fed or central banks, stimulate, they ease, right? They bring the interest rate down. They make it easier for credit to get out there in the world and to flow. Conversely, when they start increasing interest rates and tightening by removing quantitative tightening like we're doing right now, you're essentially taking blood, you're reducing the volume of blood that's flowing through the economic body, right? So just like as a person, if I stick a syringe in your arm and start pulling out your blood, at some point you're going to start feeling lightheaded and you're not going to be able to move as rapidly or swiftly or strongly as you were before. That's essentially what's going on here. The banks, by refusing to, I shouldn't say refusing, but by embracing tighter lending standards, they're putting less credit out into the economy. They're letting less credit circulate. So it has a very predictable effect. You reduce the amount of credit flowing through the economy, your sales go down, your profits go down, unemployment goes up.
That sounds like a potentially devastating thing for the economy. And to underscore this point, I want to read a quote from the most recent beige book that the Federal Reserve released. Federal Reserve Bank of New York said that conditions in the finance sector deteriorated sharply, coinciding with stress in the banking sector. Small to medium-sized banks in the district reported widespread declines in loan demand across all segments, as well as credit standards tightening noticeably for all loan types. That does not sound good. And what I was surprised at was actually not only are the banks tightening credit, there was lower demand for credit. So it's almost as if maybe Silicon Valley Bank and the banking crisis was also a shock to consumers, businesses. It was a wake-up call maybe, where everyone was like, uh-oh, wait a minute.
Well, it very well may have been. And look, if you have a demand problem and a supply problem, then you're in really bad territory, right? Because having a supply problem is when the economy can't grow as much as it wants to. But a demand problem is when you can't get the economy to grow the way that you want to, right? If you're putting credit out there, but it's not being taken because there's just not demand for it, that's an even bigger issue.
One way I like to think about this actually is like, imagine if you were someone 1 year ago, April 2022. If I said to you, Adam, 1 year ago, that a year from now, the federal funds rate would be 5%, that we would have had the second biggest bank failure of all time, that the home sales would have collapsed to their lowest level in 30 years, and home prices would have started going down, that we'd see the leading economic indicator index say a recession. If I had said to you a year ago that all those things would have happened, what would you have told me?
I would have told you, gosh, we've got to be in a pretty bad recession, and for sure the market's going to get kneecapped.
But it's amazing. All those things have happened, but the market hasn't gotten kneecapped. We haven't seen the unemployment rate surge yet, but of course, that doesn't mean that they won't. And this is maybe the trap I see some people falling into. I see it in the comment section here on my YouTube channel. I see some home buyers who are frustrated that inventory is still low in the housing market. They see some bidding wars this spring. And I see some people are just like, I'm going to take the plunge right now. This could literally be like the worst possible time to do that based on all of the leading indicators in the economy. And ultimately, though, isn't this kind of how recessions work? Don't they kind of fool you into thinking that there's not going to be a recession? I mean,
it's actually very, very common for there to be sort of this false dawn in housing right before that final domino of employment falls over. And it turns housing briefly into the sort of roach motel where everybody, hears the sirens. They get this false sense of like, oh, the bottom's in, time to get back into housing. Then the employment shoe drops. And then, everybody that got suckered in at the end there gets,
yeah. And this aligns with the so-called soft landing narrative, right? You sent me another thing here which shows newspaper clippings over the last 50 to 60 years. I believe this also was from Michael Kantrowitz, where you're seeing in 1973, economists said there was a soft landing. In 1980, they expected a soft landing. In 1989, they expected a soft landing. In 2007, Ben Bernanke and the Fed thought a soft landing was coming in 2007. They thought it was going to happen in 2000, right before the tech bust. I mean, so does this always happen?
We see it repeated again and again and again. So don't think it's different this time, folks. Oh, they're talking about a soft landing. Oh, so then we're highly likely to have one. No, they always talk about the fact that it's going to be a soft landing, no matter what the landing is. And one more slide, if you could put up here, Nick, again, from Michael Kantrowitz, in looking at all the past cycles where we've gone through this hope progression, one of the things that Michael has looked at is when did we have a soft landing? And when do we have a hard landing? And he said it's extremely clear. 3 specific precursors for a soft landing. There's 3 specific precursors for a hard landing. On the soft landing side, you have to have low inflation, modest Fed rate hiking, and bank lending easing, right? The banks are easing their lending standards. None of those are what we have today, Nick. Now let's look over at the precursors for a hard landing. You have to have an inflation problem, check. You have to have rapid Fed rate hikes, check. You have to have tightening bank lending standards, check, right? This is what gives an analyst so much confidence that A, we're going to have a recession, and B, it's going to be a hard one. I guess my underlying message here for folks is, if you do not want to get on the recession train here, right? If you want to, for whatever reason, decide, okay, I'm going to bet that the market's actually going to do pretty well this year, and we're going to have a soft landing or no landing situation. Look, that's your choice, right? My point is just be aware of what history is telling us, and be aware of what the math of the experts is saying to them. If you've got a more compelling reason for that, great. But it better be one heck of a compelling reason, because I can tell you from the data that Nick and I have been talking about here, this is about as compelling as macro data gets.
That's right, Adam. So a lot of people are going to decide right now, oh, should I buy a house? Seeing some bidding wars, prices go back up a little bit. Just understand, if you buy a house right now, you're buying at still a record bubble price. Inflation adjusted home prices in America are still the highest level they've ever been, even higher than the peak of the 06 bubble. Affordability metrics for the housing market are close to the worst they've ever been. And so if you buy today and you take the plunge, just understand it's very likely that the value of your house is going to decline and your equity is going to get eaten away. And of course, some people might be fine doing that. Some people might live in their house for 10 years and say, I'll just ride it out until the next upturn. But like you said, Adam, it's very important that people know what they're getting into and don't get deluded into thinking that, oh, there's nothing bad going on and nothing bad is going to happen.
That mentality of, well, it hasn't happened yet, so it's not going to happen. Right, that is a complete sucker's bet. And again, that's the whole reason why I shared Kantrowitz's procession here, because a procession means something has to happen first and something has to happen last, right? And if the thing that happens last hasn't happened yet, doesn't mean it's not going to happen. It just means it hasn't happened yet. But make sure whatever decision you're taking in mind takes into account the high likelihood of the probability of this thing actually happening in the future.
Now, Adam, before we sign off and do a quick little rapid fire round here, I'm going to ask you some questions about when you think certain things are going to happen. And so
go for it.
I'm going to ask you to stick your neck out here on the limb a little bit. We're not going to totally hold you to it, but number one, when do you think we're going to start to meaningfully see the unemployment rate go up?
Summer. I'll say July.
And then when do you think we'll see the Fed stop hiking interest rates?
June? Maybe. No, I take that back. I'll bet May would be the last hike, if he even hikes. It wouldn't shock me if he paused in May. But I think we got one more 25 basis point hike. Then I think we're done.
Got it. So that's one more hike. And then when do you think they'll cut rates? Like, how long are they going to keep rates at 525 basis points? And then when are they going to cut?
I'm going to stick my neck out and say they're not going to cut in 2023. I think if they cut, it's going to be in 2024, unless there is some big enough breakage that their monetary duct tape just can't keep at bay until the new year.
And when do you think the delusion in the stock market is going to be pierced? Like, we'll start to see stock prices go down closer to earnings and reflect higher interest rates. When will that kind of bear market start to unfold?
Yeah, I'm going to go with Kantrowitz on this. I think it's going to happen 2 to 3 months after we see the unemployment rate really begin to start rising. So where are we right now? I'll say once it passes 3.8%, then give it 2 months after that.
And then I have my own opinions on this one on the housing market, but I want to hear what you think about the housing market. When do you think we'll also see the shoe drop in the housing market? We had the initial price declines over the last 6 months. We had a little rally in the spring. Do you think that timeline is going to be kind of the same as the stock market as well?
Yeah, I think generally, not because they're coincident, but I think the way that housing corrections tend to happen, sort of that it takes forever and then it happens all at once kind of deal. And we peaked, we've come down, we're kind of in this sort of false dawn, like I said. I think once the housing market realizes that it is a false dawn, I think the next leg down begins to become pretty fast and pretty violent. And the reason for that is, as you and I have talked about, Nick, is sellers have been there's kind of been a standoff, right? Like a Mexican standoff between buyers and sellers right now. Buyers don't want to buy because affordability is so bad, but sellers don't want to sell because they don't want to bring the comps down, right? And I think that coalition of the sellers is the weaker of the two parties, because there's a first mover advantage if you're a seller, if you really begin to lose faith in the market stability, to say, look, if I'm one of the first out, I can capture the vast majority of the current price of my house, right? At some point, sellers are going to start bolting from the herd, but I don't think they're going to do that until we have the next perception shift in housing, right? I imagine that's probably going to be a couple more months of, mortgage rates, staying high and perhaps going back up again. I think when mortgage rates really start going back up again, this next round, that's when you're going to see some of these guys start to bolt. And that, I think, is going to begin to start the watershed.
And that might already be happening. Mortgage rates are now back up to 6, 7, and we've seen the mortgage applications go back down. But Adam, I want to thank you for being on the show here today. And I want to tell all of you viewers out there, go watch Adam's YouTube channel, the Wealthion YouTube channel. He interviews a new financial and economics expert every single day. And I'm going to have a link here in the description below to the interview he referenced with Michael Kantrowitz throughout this episode.